You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. Today is Thursday, January 29th, 2026, and we are looking at a market that is being pulled in two very different directions.
It really feels like it has a split personality, doesn't it?
It does. On one hand, the Federal Reserve just delivered a very calm, expected decision on interest rates.
But on the other hand, you have the commodity markets reacting like the world is repricing risk in real time.
And we're seeing historic highs in gold and copper, rising oil prices.
Yeah.
It's all being fueled by these escalating geopolitical tensions involving Iran.
And we're going to look at why equities are staying so steady despite all this volatility.
And what the latest signals from the bond and currency markets mean for your portfolio. Let's unpack it.
It really is a day of stark contrasts. You know, if you only looked at the bond market this morning, you would think the world was perfectly asleep.
Right.
But then you flip the screen over to commodities, and it just looks like absolute chaos.
It feels like we're reading two different books at the same time.
Mm-hmm.
One is a very dry, boring textbook on monetary policy, and the other is some kind of geopolitical thriller.
A good way to put it.
I think we have to start with the boring book, because that really sets the baseline for everything else.
Yeah.
The Federal Reserve met yesterday.
Right. Big meeting.
No rate hike, no rate cut. We're holding steady at 3.50 to 3.75%.
That is correct. And that non-move was completely priced in. If the Federal Reserve had done anything else,
Anything at all.
if they had surprised us, the markets likely would have imploded. But the story isn't the number, it's the philosophy behind it.
This is all about what Chair Powell said in the press conference. He used a phrase that just jumped out at me immediately. Higher end of neutral.
Yes.
Now, for everyone listening, let's just clarify that. Neutral is that theoretical interest rate that, neither stimulates nor slows down the economy.
Right.
So if Powell says we're at the higher end of that, he's effectively admitting they're still tapping the brakes, isn't he?
Exactly. He is acknowledging that policy is currently restrictive. The Federal Reserve is still leaning against the economy to keep inflation down.
Okay.
But, and this is the crucial pivot that the equity guys latched onto, he explicitly mentioned the path forward. He suggested that if the tariff-driven inflation we've seen on goods starts to peak later this year,
Then that restriction can be lifted.
that's it. It opens the door.
That sounds like the insurance cut narrative,
Yeah.
The idea that they can cut rates not because the economy is crashing and burning, but just to normalize things as inflation cools.
It is the Goldilocks scenario investors dream of. Powell is essentially saying, we don't need a recession to justify cutting rates, we just need inflation to behave.
So it keeps the dream of cheap money alive without committing him to a specific date.
It buys the central bank optionality.
And looking at the reaction, the stock market just ate it up. Stocks are steady, the dollar's flat.
Mm-hmm.
It's a definition of a no news is good news day for the S&P 500.
Mm-hmm.
But that calmness feels, artificial to me.
I agree.
Because if you step outside the stock exchange and look at the physical world, the stuff we actually dig out of the ground, there is zero calmness.
That is the disconnect. While stock traders are high-fiving over neutral rates, commodity traders seem to be panic buying.
Okay, so let's talk about gold.
Yeah.
Spot prices are pressing just shy of $5,600 an ounce.
Yeah.
I had to double check that figure this morning because it looked like a typo. $5,600. That's not a normal inflation hedge.
No, that's a crisis trade. It is historic. And you have to peel back the layers on why.
Right.
Yes, the dollar softened a tiny bit after the Federal Reserve spoke. And a cheaper dollar usually boosts gold, but that accounts for maybe $50 of the move. It does not explain a surge to $5,600.
So who's buying? Is this retail investors buying coins, or is this, central banks loading up the vaults?
It's a mix, but the fear bid is dominant right now. This is institutional money looking for assets with no counterparty risk.
Okay, explain that.
Well, if you own a bond, you depend on the government to pay you back. If you own a stock, you depend on the company.
Sure.
If you own physical gold, you depend on nobody. When geopolitical tension spikes, which we'll definitely get to, capital flees to the one asset that cannot go bankrupt.
I noticed silver is tagging along, hitting new highs, but it's lagging gold slightly. Usually in a roaring bull market, silver acts like gold on steroids. it runs faster.
That's a great point.
The fact that it's lagging
Does that worry you at all?
actually clarifies things for me. It tells me this isn't purely a speculative mania.
How so?
If it were just greedy traders chasing charts, silver would be outperforming because it's cheaper and more volatile. The fact that gold is leading tells us this is a defensive move. It's about preservation of capital, not just speculation.
Then we have the other side of the metal coin. Copper. Dr. Copper.
Mm-hmm.
Usually this tells us about global growth factories, housing, GDP. It just smashed through $14,000 a ton to hit $14,120.
An incredible move. Is the global economy really booming enough to justify that? Because the manufacturing data I'm seeing is mediocre at best.
This is where you have to throw out the old textbook. Historically, yes, copper equals GDP. Today, copper equals artificial intelligence.
We're pinning this on AI.
We have to. The market has effectively repriced copper from a cyclical industrial metal to a structural technology necessity.
Okay, walk me through that.
Think about what an AI build-out actually looks like physically. It isn't just software code floating in the cloud. It's millions of GPUs running in massive data centers.
And those data centers need power.
Massive amounts of power. You need to upgrade the electrical grid to get the power to the facility. Then inside the facility, you need these elaborate cooling systems because those chips run incredibly hot.
I see where you're going with this.
All of that infrastructure, the grid, the transformers, the heat exchangers, is made of copper. You cannot have the AI revolution without rewiring the physical world first.
That is a huge aha moment. We tend to think of the cloud as ethereal, but it's grounded in heavy metal.
That's it.
So gold is up because people are scared of the future, and copper is up because people are building the future.
Precisely. It is fear versus structural growth. And right now, both trades are winning.
Let's pivot to the third leg of this stool, which brings us right back to the fear side. Energy.
Right.
Crude oil is pushing fresh 4-month highs. Brent crude is over $69 a barrel. Now, 69 might not sound like a disaster compared to historical spikes, but the momentum feels aggressive.
It is aggressive. And unlike copper, this isn't about demand. We aren't suddenly driving twice as many miles or shipping twice as many goods. This is a geopolitical premium.
So you're paying extra for every barrel today just in case the supply gets cut off next week.
That's exactly what it is.
And the center of this risk is Iran. The headlines are getting very specific. We're hearing reports that the United States is considering a new large-scale strike.
And the context here is the stalled nuclear progress. The negotiations have effectively hit a wall. Silence. And in that silence, options are being weighed in Washington.
And we're not just talking about sanctions anymore.
No. The reports suggest potential airstrikes and, more alarmingly, targeting Iranian leadership and security officials.
Targeting leadership is a different ballgame. That's not degrading a facility. That's regime destabilization tactics.
It is a massive escalation ladder.
Yeah.
And even if the United States doesn't pull the trigger, the fact that these options are on the table forces oil traders to hedge.
They have to.
They have to ask, what if the Strait of Hormuz gets closed? That choke point controls a huge percentage of the world's oil transit. If you think there's even a 10% chance of a conflict there, you have to buy oil futures today.
It's classic risk pricing. You buy the insurance before the house is on fire.
Exactly.
But here's the anomaly that confuses me. Oil is panicking, but natural gas is crashing.
Yeah.
Henry Hub prices are dropping below $4. Usually, energy moves together. Why the divergence?
That highlights the difference between a global market and, well, a local weather report. Natural gas in the United States has been driven by those Arctic storms we saw earlier in the month. Everyone turned up the heat, demand spiked, now the storms are fading, the weather is normalizing, so the gas price is collapsing back to earth.
So gas is watching the Weather Channel, and oil is watching CNN International.
That is the perfect way to frame it. Gas is domestic and weather-driven right now. Oil is international and war-driven.
And speaking of international tension, it's not just contained to the United States and Iran. The diplomatic map looks like a mess of red string right now.
It really does.
I saw a report about Turkey foiling an intelligence plot at Incirlik Air Base.
That is a huge deal that flew under the radar for many. Incirlik isn't just a base, it's a NATO hub. It has housed tactical nuclear weapons in the past. It's a logistics spine for the region.
So an Iranian plot there.
If you have Iranian intelligence plots targeting Incirlik, that is Iran poking a finger directly in the eye of the North Atlantic Treaty Organization.
It widens the conflict from a bilateral spat to a NATO-level issue.
It has to.
And Europe seems to be responding. The European Union is talking about sanctioning the IRGC, the Islamic Revolutionary Guard Corps. That's a shift.
It is. Europe usually tries to play the honest broker or the mediator.
So they've run out of patience.
It seems so. Designating the IRGC would align Brussels with Washington completely. It closes off one of the last diplomatic back channels Tehran had, so the diplomatic noose is tightening.
And that feeds right back into that oil price and that gold demand.
Exactly.
Amidst all this saber rattling, there was one piece of news that felt, well, bizarrely friendly. A move from Beijing.
It seemed completely out of left field, didn't it?
It does. President Xi is talking about a unilateral visa-free system for British nationals. The U.S. and China are at each other's throats over trade and tech, but suddenly the U.K. gets a free pass. What's the strategy there?
It's a classic wedge strategy. China knows its relationship with Washington is broken and likely won't get fixed soon. But they can't afford to be isolated from the entire West. They need foreign capital. So they look at the United Kingdom, they look at Europe, and they say, hey, we're open for business, we're reasonable.
It's smart statecraft. It differentiates the UK from the US. You guys in London can come visit, do deals, no paperwork required. It makes it harder for the United States to build a unified anti-China coalition.
Exactly. It signals openness while costing them absolutely nothing. It's a low-cost, high-reward diplomatic maneuver.
Okay, let's bring this down to the brass tacks for the listener's portfolio.
Oh.
We've covered the Federal Reserve, commodities, and geopolitics. How is this bleeding into currencies?
Well, we said the dollar is flat, waiting for data. But there are clear winners and losers here if you look at the commodity crosses.
Okay, like what?
Look at the Australian dollar. It is significantly outperforming everything else today.
The rocks and crops trade.
That's it. Australia digs things out of the ground and sells them. When copper is at $14,000 and gold is at $5,600, the Australian terms of trade explode higher.
So it's a great lesson. Even if the Federal Reserve is boring, a commodity boom can drive a currency rally all on its own.
Precisely.
So if you're long the Australian dollar, you're cheering for the AI copper boom.
Yeah.
What about the defensive side? If I'm scared of the Iran situation, where am I hiding?
You're in the Japanese yen. We're seeing the exchange rate for the dollar against the yen slip below its 100-day average. That's a significant technical breakdown.
Right, Japan. Their economy isn't exactly a powerhouse of growth right now.
It's muscle memory. Japan is the world's largest creditor nation. When the world gets scary, money comes home to Japan. It's the default risk-off currency.
So we have this split. The Australian dollar is up on growth and inflation.
While the Japanese yen is up on fear.
And the euro, just caught in the middle.
The euro is just existing. It's drifting below 1.2 against the dollar. It doesn't have a strong story right now. It is effectively a spectator.
So let's try to synthesize this for the listener. We have a very confusing picture. One, the Federal Reserve is calm, hinting at cuts, and the stock market loves it.
Right.
Two, the physical market is screaming that supply chains are stressed, war is possible, and inflation might not be dead.
It's a market suffering from cognitive dissonance. It's pricing in two contradictory futures at the same time. On one hand, the copper price says massive growth. We're going to build the AI future.
Right.
On the other hand, the gold and oil prices say scarcity and destruction. And the equity market is just sitting in the middle saying, as long as interest rates don't go up, I'm happy.
It feels like hitting the gas and the brake at the same time. Something has to give.
That is the danger. You can't have input costs, energy, and metals running at record highs forever without it hurting corporate margins. Eventually, that inflation bleeds into the stock market.
So the boring meeting at the Federal Reserve might have lulled equity investors into a false sense of security.
I think complacency is the biggest risk right now.
Yeah.
It's very easy to look at the S&P 500 and think everything is fine. But raw materials are usually a leading indicator.
They sniff out the trouble first.
They do. If oil spikes to $90 because of an airstrike, the Federal Reserve's neutral rate talk goes out the window. If copper stays this expensive, the AI rollout slows down or gets much pricier.
So the commodity market is effectively setting a ceiling, on how much risk the stock market can take.
That's a great way to put it. It's a ceiling.
And that is the question I want to leave everyone with. Are stocks just late to the party, or do they know something the commodity guys don't?
I think we'll find out soon enough. Watch the commodities. If they keep rallying, the stock market's calm isn't going to last.
Thanks for listening to the Financial Source Podcast. See you next time.